We're pleased to be joined right now by Austan Goolsbee. He is the president of the Chicago Fed. Good morning, Austan.
Hey, Steve. How are you?
Great. Listen, I want to just start off with the getting a tally here. Where are we on the countdown to cuts? Are we? Is it 3-2? What's the score here?
Who's on which team? You know I'm not allowed to talk for anyone else on the FOMC, so I know you're not asking me that. I've been saying
your assessment.
My assessment is that I've been laying out for more than a year what are the criteria that we would see for rate increases, for rate holding, for rate cuts. I think we've got somewhat historic restrictiveness. The Fed funds rate minus inflation, the real Fed funds rate, is as high as it's been in decades. When you want to be that restrictive is when you feel like there's danger of overheating, or as we did in the U.S., if you get the inflation rate up too high. Second half of last year, we had outstanding dual mandate performance. That is, inflation came down almost as much as we've seen in any year, and we did not have a recession. Start of this year, we saw inflation kicking back up, and we've been trying to figure out and determine from the data, is that a sign of re-overheating, or is that just a blip? I think if we get more months like what we have just seen in the last month on inflation, coupled with slowing conditions in some of the other parts of the real economy, then you would have to start questioning, should we remain as restrictive as we've been?
Right. And I get that. The question, I know, I'm just wondering where you stand in terms of having that confidence to cut. And when I said 3-2, I meant 3 bad months. And we've had, I don't know if you describe it this way, but 2 good months of inflation, especially the last one that we had. And I'm looking at the Cleveland Fed now casting for inflation. It looks pretty good for the month of June so far. Obviously, it's just a forecast. But where are you in your confidence to cut it?
Yeah, look, I'm closet optimistic that we're going to see improvement. If you break down the housing, services, goods, you started to see the progress that we have been expecting on housing beginning. Hopefully that continues. And on services and on goods, there's still a decent run rate. So even the 3 bad months, we really had 1 awful month in January. And then it's been improving since then. And that was preceded by 7 outstanding months. So I'm hopeful that we're going to get a little bit more confidence that on the inflation side, we're heading back to 2. And on the real side, you can't describe this as traditional overheating at the least. You've got a couple of warning signs. If you look at rising UI claims, if you look at rising delinquencies, and what seems to be a cooling of consumer spending, I just think taken in the context of how all the other advanced economies are doing, it's worth wondering about where we are on our restrictiveness scale.
Well, yeah, I wanted to get to that because there's a chart up right now, Austan, that shows the inflation rate, which is the blue line, declining, and the unemployment rate actually inching up. I know it's still at a very low level. You talked last week, Austan, about pain in the economy. How much concern do you have about a slowdown? And tell us where we are on the golden path. Are we back on the golden path? Are we potentially veering off it to the other side, which was the side of greater economic weakness?
Yeah, that's always the danger. I'm always going to be concerned. You know, I say central bankers' job, be concerned about everything. That said, you got a couple of warning signals coming from the real side of the economy. The golden path was my description for 2023, that we could get inflation down a lot without having a recession. Now, let's hope we still get a little more of the golden magic coming here into 2024. And I, as I say, I'm closet optimist. I think it is possible. But you cannot help but look at the real side economy and conclude, I think, this is not overheating. Okay, the reason to be extra restrictive, as we have been, is because you're trying to guard against overheating. if unemployment claims are going up, the unemployment rate is inching up. Many of the other measures have cooled down to something like what they were before the pandemic, and you start to see weakness on consumer spending. I think then you got to have what we call the balance in the mandate, that we got two sides of the dual mandate. And if you're going to be extra restrictive for too long, you're going to have to start worrying about what's happening to the real economy.
When you talk about confidence to cut rates, Austan, do you agree with Chair Powell, who has talked about cuts being a process? Or is it possible to do what Christine Lagarde did in Europe, which is to do one and then kind of not promise additional ones? And just by way of background, the Fed did that back in '96, which is something that Vice Chair Jefferson has brought forward as a potential analog for today. To do a cut, hang out, see how it works, rather than essentially tell the market and the country that you're doing a process or series of cuts.
This sounds like an abstract hypothetical, and you know I hate abstract hypotheticals. I usually always agree with Chair Powell.
I disagree, Austan. Austan, I disagree. It's not theoretical. Chair Powell said specifically that he sees cuts as a process. He said very much that on the one hand, why do one cut if you're not going to do a series of cuts? So that's why it's not a theoretical thing. It's something the chair actually said.
I got you. I'm not going to weigh in on that. That's going to break the FOMC communications policy on two grounds. I'm going to start talking about thoughts that are in Jay Powell's head and the future about what the rate cuts are going to be. I don't like tying our hands, even partially. I do like the idea that as we make movements, we're not willy-nilly surprising people. What I like is for the public to understand our reaction function. And I like that over the last year and a half, we've laid down criteria for here's what we're looking for in the economy, that we're going to actually look in the data, and that's what's going to determine whether we're able to make cuts, whether we're going to hold where we are, whether we're going to increase rates. All along that way, I feel like we've been pretty clear about that reaction function, and that I take as a good sign that the market's reactions often are biggest when the data come out, not when we make statements. To me, that's kind of an indicator that we're doing the communication the right way.
Let's talk about one piece of data which is really interesting, and I honestly, I'll admit, I can't get my head around this, which is how is Fed policy affecting the housing market? We had a report last week looking at the data that housing prices were rising again. I think about high interest rates right now. And just for the record, folks, before Austan was at the Fed, or even when he was in the government, you could talk to him about theoretical concepts like this, and he would help explain or give his opinion on it. So, Austan, I'm trying to get my brain around this. You have high interest rates, which, at least on one level, it makes it more difficult to build housing. There's a housing shortage in the country. So how is it that keeping interest rates high is helping housing prices decline and helping the overall inflation index?
Yeah. Now, the only thing I'll say is, as a historical matter, we always say that housing is one of the main transmission mechanisms for monetary policy. This dynamic that when rates go up, it also suppresses the supply of housing because nobody wants to leave their low mortgage rate. That's always true. That's always true. So the question is, what makes this moment different than previous cycles? I do think there is one element that makes this different, which is this increase in rates followed a historically low rates for a long time. So in a way, you got more lock-in to those low rates than you would have had in previous cycles. So I do think there is some dynamic of that explains part of the puzzle of why house price inflation remained higher than it was. And might also explain why new construction was a little stronger than you would have anticipated it would be, given what happened to rates, because in a way it's filling in for the existing homes that aren't being put on the market. Now, that said, it's worth remembering this is just a temporary phenomenon, as it's only in this interim period where you're going to see that supply component. And it's totally separate from the second puzzle of housing, which has been the market rents normally come into the actual inflation series with a bit of a lag. And that lag, just mechanical lag, has been longer than what we thought it should be. So I still think, regardless of what's happening in the resale single-family housing price part of the market, there's still wide availability that housing inflation can come down, and that we will start to see in the official statistics the reflection of what's happened in the market rents data, where the inflation rate has come down pretty significantly.